So are we... Oh, wait a minute. You've got a piece of stock market trivia.
Well, this is, I think we gave it away, but not everyone listens that carefully. So let's pose the question to the viewer. What asset class represents about 40% of average daily trading volume in America?
ETFs.
That's right.
Wow.
They've been around
Now
since
that,
1993.
That's what you get with 40 years of television experience. Right there. There we saw it.
Listen to the Pisani. The Pisani is with us along with Tom Lydon. He is editor of ETFtrends.com. So, Bob, why don't you start us off with, started in 1993. Right. Even during the crisis, they've actually continued to expand their dominance.
Yeah, I have been a big backer of ETFs for a very simple reason. It's a fast, efficient, and easy way for self-directed investors to get involved in the stock market. And basically, you own baskets of stock in a single trade. The most famous one is the SPDR, SPY. It's a basket of all 500 stocks in the S&P 500. You can go in and out. They've expanded now. There's over 600 of them available. You can buy long, you can buy short, you can buy double long, you can buy double short. And Tom Lydon, here's my question for you. When is these going to be a serious competition for mutual funds? Because why should people pay 1% front-end low, 2% back-end low? Why should people be paying these high fees when you can get the same kind of performance largely through exchange-traded funds?
Well, you're absolutely right, Bob, but still, ETFs only account for 6% of overall mutual fund assets, so it's not as though they're going to take over mutual funds anytime soon. But if we keep hammering home all these advantages, we'll get there one day. And as you know, when you and I talk about this, one day ETFs will make their way into 401k plans, which will be better for all of us.
Here's my question for both of you, though, because you just highlighted something that is my one real concern. You're 6% of assets, right? But 40% of volume, which would mean that it's highly sophisticated hedge funds that are trading them.
Can we back up just a minute?
Okay.
This 40% of volume figure, what does that mean? Are the ETFs themselves 40% of volume, or is the trading in ETFs driving 40% of the volume in stocks?
The answer is both of them, because they create, they buy and sell stocks that underlie the index. Right. You can't create this synthetically. If suddenly there is a massive buying in the SPDR, the S&P 500, you have to buy the underlying companies. The fund sponsor has to buy stocks in proportion to how much it's going up.
Right, but this again comes to my question of, Tom, isn't this mean that it's sophisticated players who are using these, and does that, it may or may not, but does that put a regular retail investor at a disadvantage?
No, it really doesn't, because the ETFs, as Bob said, represent the underlying stocks. So it's really a little bit for everybody. If you're a long-term asset allocation investor, you've got the transparency, you've got the cost effectiveness, and so many asset classes to choose from. On the other hand of the other end of the spectrum, if you're a day trader and you decide you want to go long or leverage or triple leverage, those tools are there for you as well.
Tom, why do I keep hearing horror stories about how the ETF gets out of whack with its net asset value?
Well, Mark, the question is really, most ETFs and the vast majority of ETFs really trade very, very closely to their underlying intrinsic value.
Right.
From time to time, if you get in a situation, for example, if there's a Peru ETF and those markets tend to be very thinly traded and there's a lot of buying and selling, there's always the potential that could get out of whack. But if you look at the vast amount of volume, especially domestically and in developed markets, it's very, very true. And it's a job of...
I'm sorry to interrupt, but we are running short of time. And this, I think, is a very important point. Are you willing to make the same claim for commodity-based ETFs? Because we had a guest on who pointed out that when he bought ETFs designed to profit if oil went down, oil did go down, but his ETFs went down too. Yeah. So can you make that claim for the commodities?
As Bob will tell you, you have to understand which ETF you're buying. Yeah. If you're buying the wrong ETF that's not pegged to the price of oil or futures that might be dated in the future, you might not be buying exactly what you're thinking you're buying.
The problem is this: with commodities, some of these don't own the front month contract. They own a series of contracts that are going out many, many months. So that doesn't necessarily trap that front month contract. Bottom line is this: we're going to get ETFs in 401ks. It's going to happen in the next few years, and investors are going to be better for it. They'll have more choices, and it'll be cheaper for them overall.
But my only concern is if you're going to buy these things, you must investigate them.
Yes.
You can't.
Absolutely.
It's not like a share of GE or Citigroup.
No.
There are wrinkles, and you must know what they are.
And the inverse ETFs do have some tracking problems and issues that has to do with the way they're set up. And this is a completely different discussion, but we'll be happy to bring Tom back and we'll explain why.
All right. Well, thanks so much to both of you, at least for getting this started.
Thanks, folks.
Tom and Bob.
Yeah. I didn't